everybody. Thank you for joining Coresight Research and our launch of Retail Legends. We're letting people join our event, so we're going to wait a few minutes before we start the event. But for right now, Michael is here. Michael Appel, you want to say hello?
Yeah. Good afternoon, everyone. I guess it's 1 o'clock. It's afternoon, so nice to be with you. I'm coming to you from my kitchen out in the Hamptons, so that's not a fake backdrop.
Nice, nice.
Real thing, and really delighted to be here.
So today what the theme is really about is, Michael is a turnaround expert, got a lot of experience as a retailer, and can we use that paradigm, can we use that experience and help and think about how we navigate what we're going through today. So we're just gonna, more people are coming in, we're just gonna give people the opportunity to join the webinar, and we'll start in a minute or two.
Great.
So we're so glad that the people here can join Coresight Research webinar series. This is the launch of Retail Legends. Michael Appel is our first participant. We're so delighted to have Michael here. My name is Marie Driscoll. I'm Managing Director of Luxury and Fashion at Coresight Research. We sit at the intersection of research and technology. We're so glad that Michael is here to join us. To begin with, Michael has had a stellar career in retail, worked with lots of famous names across multiple retail channels. So Michael, why don't you just share a few of the high notes of your career?
Oh, great. Thank you, Marie. I'm delighted to be here. I have the greatest respect for Coresight, Deborah and Marie, and it's great to be joining you. So just a little bit about my career. I started my career in retail in 1973 in Bloomingdale, where I spent 10 years as a merchant. And I was a footwear buyer, and then became the vice president and divisional merchandise manager. I basically spent the first 20 years of my career as a merchant and as a merchant operator, and did my first turnaround actually in 1987 when I was president of Conference, which was a hardline specialty all-day retail. And beginning in 1990, I began to work with challenged retailers, both in bricks and mortar, direct response, and consumer companies, and served as interim CEO, CRO, COO, sometimes brought in by lender groups and bondholders, and sometimes by private equity firms. And I have a great breadth of experience. It's kind of unusual, actually, when I talk to my colleagues in terms of the breadth and diversity of my experience in pretty much every category of merchandise, and also across all channels, including department stores, price, multi-unit specialty, and luxury as well as value. And you know, I really spent that time leading such well-known companies through turnarounds, challenges, business building situations like Laura Ashley, Caswell Massey, with Ken's and Childs, Casper and Eric Klein, where I was basically the advisor to bondholders, and for that work, I won the Turnaround of the Year Award in 2004 for Turnaround Management, and other companies such as Bashford and Michael Appel Luxury. For the past 2.5 years, until actually last month, I've been as the chairman, interim CEO, and CEO of Route 21, the fast fashion apparel retailer, where I basically took the company through its turnaround and is growth.
Okay, so that's quite
so with that, I'll turn it back to Marie.
Thank you for sharing that. Lots of great names through retail and consumer products, luxury, all of it. So, you know, we've talked about your strategy for turnarounds. You have a 5-pronged strategy. Can you articulate that for us?
Sure. And this is really something that I think is applicable to most retail and consumer goods and direct anywhere where you're meeting with the consumer. And so the 5 prongs of the strategy involved, and this gets articulated once you actually assess the company and understand where you have to place your emphasis. But they always involve number one, understanding the customer, right? And a deep understanding of the customer is critical because that really touches everything that you're going to do in terms of either turning around the company and then building it. Second is really is team, right? Evaluate the talent and then bring in the best people to drive the turnaround and then to build it. And I can't stress that too much. I think in the retail business, in particular, because of its complexity, the quality of your team, right, is critical. It doesn't mean that it has to be a cast of thousands, right? A great core team at the top can really get a lot done. Then the product. Obviously, product is critical. And in some cases, it's fixing the product itself because it's not resonating with the consumer. Can't do that without the talent. In other parts of product is what should your assortments look like? Are you really getting the right turn? Are you really having the right categories that will drive the business and breadth of your assortments? Lots to do as far as product is concerned. Then the next, which I think has become incredibly important today, the pace of change with our consumer and their ability to much of it is really technology. I don't think that you can be successful today unless you embed technology in your business operations. And you need to do that in order to drive results. We've had very, and that can go anywhere from digital testing of product, which I've done with a great company called Coresight, which really helped us, and other companies, 2 companies I actually involved with to buy the right product in the right quantities and also not buy a product that wasn't going to resonate. And then, the technology in terms of, assortment optimization, size optimization, price optimization, anything that, and for example, in the stores, really using technology in terms of understanding how to schedule use people and when. All of these things, technology is able enables you to do. And you can't do it, especially if you've got scale and lots of locations, unless you use technology to help you. And then the 5th thing is liquidity. And basically, really in every situation, and it's really whether you're you're in a dire turnaround or you're challenged or you're in growth mode. I mean, liquidity is key. And in turnaround situations, liquidity buys you the time and the runway to fund your turnaround. Because my experience has been that it always takes more time and more money to affect the turnaround in the retail business. Because very often, when you get to a situation where you need to turn around the business, whether it's just challenged and results aren't good, or whether you're going through Chapter 11, the company has been suffering for a while. So it usually takes longer than you think to get things back to stabilization and then to give you the runway for growth. So you can have the greatest team and understand your customer and the right technology, but if you don't have liquidity, you won't be able to get to the
Right. And what you're saying is liquidity is paramount at the beginning and at the end. And also what I heard you say is it always takes longer than you think, and it always costs more money than you think.
Right. If you look at some of the great turnarounds out there, the turnaround the Gucci, some of the other at Burberry, right? Those turnarounds, 3 to 5 years until they got traction. So you have to be realistic about what it's gonna, how much capital you're going to need and how much time you're going to need, because most of the time you're going to be evaluating evaluating and replacing the management team, putting in technology, etc. And technology initiatives a lot longer than most people think. And in order to re-platform your website, to do a loyalty program, for example, those things, implementation takes a lot longer than you think because it's really complex and it touches a lot of business, from from the financial pieces to the OS, control, et cetera, et cetera. So that's why you really need to be realistic about what it's going to do.
Okay. Well, so tell me, what do you see different between your typical turnaround situation and the situation we're in today with coronavirus and how it's impacting retailers, the economy, the consumer?
Yeah. Well, I think what's different is the fact that for most retailers, other than the few that are open, and the ones that are open are mostly the biggest, best capital retailers, that, the vast majority of them, most of the revenue cut off because the stores are closed. So, especially with with a lot of the apparel retailers, it's tough. And so I think that all of a sudden, whereas before you might have the stores open but not performing, here they're not even open. So you have big revenue sources not there. And for a lot of retailers today, what they have is only their e-commerce channel, which could be nothing, but in the off-pricers like TJ Maxx, et cetera, to pretty significant. Williams Sonoma, I think, have 40% at least online. But for most people, it's not enough to really cover your loss of receipts. So I think in a situation like this, liquidity is the number one thing, because you have to figure out, how long is it going to be before we get back and turn the tap on and start getting revenue. It's just more extreme version of it.
Okay. What other things do you do now in terms of like communicating? Like, how would you communicate? Would you communicate the same way with your vendors, your employees?
Well, I think it's more. Well, you've got a couple of things going on, right? You've got to make decisions very quickly, right? And you've got to communicate those decisions. You've got to have a strategy in place, okay? And you have to say, if you look at the situation now, is that you don't have revenues coming in, so therefore, you look at it and you look at, okay, what are the big costs of your business? Well, it's cost of goods, right? And it's rent and it's personnel. So you look at that and you say, you got to try to right size your cash out with whatever little cash you have coming in, and take action quickly to address it. And so there's a number of things you have to look at. I mean, in terms of cost of goods, basically a lot of people are just saying we're not receiving goods until we see light at the end of the tunnel, because number one, we're not reporting sales, or very little sales. And number two, we also are going to have a lot of inventory in our stores, which, if you think about when this happened, certainly in apparel retail, it's at sort of the height of the pre-Easter season, right? So they're sitting with a fairly decent amount of inventory, where they're expected to do a lot of business. And so you have to think about that. And so basically, if you look at it, you could say it's pretty simple. Not so simple to do it, but basically, you have to cut receipts, and you have to look at that in terms of your critical vendors coming out, because you also have to look at the other side. At some point in time, stores are going to reopen, things are going to get back to normal. But the question is, what is that trajectory going to look like? So you need to put together a model, right, of sort of sources and uses of funds.
Sorry to interrupt, Michael. This is Mara from Coresight. We're having a little bit of trouble hearing you because your internet seems to be breaking up. Is it possible for you to dial in with your phone?
Yeah, if you give me the dial-in.
Great. Hold on 1 second and I'll get that for you.
For sure. Just
And while Michael does that, I just want to tell the audience that if you have any questions, there's a chat questions, so you could chat some questions, and we'll try to, and I will try and include them in the questions to Michael. So he'll be
Okay.
right back with us in a minute.
I just need the dial-in number.
Okay, Mata, we'll take care of that.
I'm
Meanwhile-
setting that right now. Give me 1 second. Sorry, guys. Technology.
Technology, the integration of technology. I mean, Michael talked about how important technology was. He talked about how it takes longer to implement and integrate your technology, excuse me, in a turnaround, and new technology too. In terms, I hope everybody heard his 5-prong approach. What he talked about was the customer, the team, the product, technology, and liquidity. And liquidity being really paramount in terms of a turnaround. You need liquidity. I'm going to ask.
What number should I dial in?
I'm going to ask him about, how you preserve your liquidity, increase your liquidity. In the last 2 weeks, we've seen numerous retailers take action to improve their liquidity position, from suspending dividends to closing stores to stopping vendor acceptances, so they're no longer taking.
Michael, I just sent you a chat with it.
Press chat.
Yeah, check your chat.
Okay.
Bottom of the screen.
Yeah. So dial in that number. Okay.
Exactly.
Okay.
So
All right.
Michael,
So it's good to have a backup. All right.
And then make sure you mute your computer once you get dialed on, so this way we don't get an echo from you.
Okay. So Michael should be joining us in a minute. Why don't we release the survey? We'd like to release to you a poll of 3 questions, and it'd be great if you could answer them, and we'll address these questions during the course of the rest of the conversation. Some other things that we're seeing retailers do to improve their liquidity is they're stopping their dividends, they're drawing down lines of credit.
Okay.
They're stopping their share buyback programs, which are use of funds that are extraneous at this point. So Michael, did you get in?
No, because I see the poll in progress on my phone. Is there any way to?
Can you just call in on the line?
No.
Michael, don't use the app. Just dial the phone number.
That's what I'm going to do. All right.
Okay. Michael was saying that as you deal with a situation like we have today, you have to make assumptions with sensitivity in terms of how long this is going to go on, how deep it is, and when we'll come out, and how we come out of it. And then you manage to those set of assumptions. The next thing is really attacking all sources of liquidity. Stop your shipments if you're a retailer. Stop taking vendor shipments. And we've seen retailers do that. Nothing's off the table. But at the same time, you really have to manage the fact that on the other side of this, when we come out of this, you will want to work with these people. They'll be your partners. These companies will be your partners. So you have to be sensitive to that. Also realize that there will be pent-up demand. So you want to have open, frank communication with all of the stakeholders, the vendor community, your landlords, your employees, your shareholders, your banks. You want to make sure you have availability with the banks. And we're seeing, as I said, retailers draw down their credit facilities. Michael, are you able to dial in? So, I think I can speak to some of the points Michael was talking about in terms of e-commerce being the channel that is open. Frankly, we've seen some distribution channels, distribution centers close, and it may be a function of these employees at those centers being ill, or maybe really demand has been so depleted that it's not even necessary that they remain open. But if e-commerce, if you're executing through your e-commerce channel, you want to like feed that channel, even though it may be less profitable. It's the only way you're connecting with your consumer, and you want to keep connecting with your consumer.
Marie, can you hear me?
I can connect.
You can? Can you hear me again?
I can.
Okay.
Madam? Okay.
Not entered any numbers. Please
Okay.
re-enter
Okay, so Michael has
I can't,
password
I can't.
followed by pound.
I can't get this thing. Okay, I'll do the best I can, guys. Okay. Marie?
Okay, so you were just talking about operating expenses and gross margin and how you would try and lower those costs.
Right. So basically, cut your receipts. Okay. Reduce your SG&A. Basically, you're not gonna need the staff that you needed before. Okay. And you know, what are they? Rent? Well, for most retailers, they're not the operators of these centers have closed them, so there's no reason to have to pay rent until those centers are open. And so, you know, most retailers are not paying rent. So rent, obviously, store staffing, and then the other is really in terms of sources of liquidity, really accessing your bank lines. And I think that's critical.
So
People
interestingly,
who are out in front or had good liquidity have been able to do that.
so I don't know if you can see the results of the poll, because I took the poll while you were gone.
Right,
And
I saw it.
okay, 64% of those polled said that they would, yes, stop paying rents while the stores and malls are closed. And here I'm going to share the results so everyone can see it. And how important is reducing receipts? 57% of the people think it's critical. 29 think it's important. So only 14% think it's somewhat important, which is interesting, very small piece.
Right. I mean, to me, I'm surprised that critical wasn't a larger number. I mean, I can remember in a number of companies, recently, that we saw that the sales weren't going to be there. I mean, basically reduced the receipts so that we weren't going to operate with inventory levels that were going to result in amount of clearance and markdown. So if you have a good model, I think it's critical to develop a good model in that regard that's got sensitivities to it. Then you have to do that. Now, at the same time, you also have to look ahead and say you don't want to burn all your bridges with vendors. So the question is, you've got to really identify the critical vendors that you know are going to be important to you going forward, and also the categories based on when you think you're going to open. I mean, people think they're going to open in May and June, right? What merchandise are you going to need then, right? And then if you're a junior retailer, you're thinking about back to school, which begins in July. So you have to look ahead, and you have to communicate with your vendors and work out, you know, either late deliveries or cutting receipts or extending terms. And the relationships that you have are critical. Relationships with all of your stakeholders.
Right.
The relationship with your vendors is critical, whether they're bank or your ABL provider, which hopefully you had a good relationship before. And I think if you've got good communication, good relationships with stakeholders in your company, and the stakeholders include everything from your shareholders to bondholders to banks to your vendors, and of course your consumers and your employees. You know, the strength of that relationship and your ability to communicate in a calm and measured fashion, and to be realistic with them as to what's going to happen is really, really critical in terms of being able to get out.
So if, would you be would you be thinking about your store fleet right now? And on the others, like right now, obviously the stores are closed. How would you think about your store fleet post-June when the stores are back open? Would you be like trying to exit, like how would you think through this?
Well, I think it depends on the situation you're in. I mean, the situation, if your store fleet, if the stores were four-wall positive, or only a small, tiny number, then I don't really want to do that, right? You want to figure out a way to keep those stores open and funded, because, actually a situation like this, again, but if you have it's an opportunity. You can look at it as an opportunity to really become more of a world-class retailer on the way out, and start looking things a little bit differently. Some companies, however, a large percentage, 20-30% of their fleet might be well negative. So I think that's really important to consider and say, okay, now I'm going to have to take action, and that may mean, obviously negotiation with landlords, and if you have a good real estate consulting firm, which I utilize in almost every case to help you in that regard.
So,
or you can either get rents lowered or be able to exit.
So, like, to the issue of store closures, we asked the audience what percent of retail locations do they think would close and not reopen as a direct result of coronavirus, and 10% was the answer for 36% of the audience, and 25% of those stores out of the U.S. store fleet, really. 43% of our audience said 25% or more of U.S. stores would close. Now that's a huge number, and yet we know that we've been talking about the U.S. Store environment being overstored for like
Correct.
20, 30 years.
Right, exactly. And what's interesting is even with the large number of store closures that we've seen over the last couple of years, there's also been a lot of store openings. The in the value sector, the off-price sector, in the dollar store sector, there have been thousands of stores that have been open, in addition to new concepts that have been open. So the net result really hasn't addressed the great imbalance there is between square footage per capita in this country and every other country in the world. So, these types of events get people focused on really saying we have to right-size our fleet. And if companies haven't, okay, they're going to be more vulnerable, because landlords are going to look at whether they think you have a sustainable business model, and they'll be more or less willing to negotiate with you, based on what they think of as whether you're going to make it or not. So that's going to be really interesting to see. So I think you're going to see an acceleration of some of the either store closings in retailers, and a continued liquidation of retailers that just make it through.
Yeah. So, like, we've seen how strong the results are recently at Target, and Walmart has had some good numbers too, some good indications. What companies do you think are most likely to survive this, and where do you see liquidations happening?
Yeah, well, I think the people that will survive, I think the bifurcation in performance has been, the good performers have been either at the luxury end or the value end, or they have niche businesses or very strong brand equity. So if you're stuck in the middle, I think you've got a problem. And that really hasn't changed. The recession of 2008, where it was quite clear that customers were beginning to luxury was strong because you had an increasing number of people that had the money, and at the other end, off-price value retailers were getting it, because a lot of customers just said, you know what, we'll trade down if the product is good enough. It doesn't have to be, it doesn't have to be perfect. Okay, it's got to be good enough and good value, and we'd rather spend our money in that. And so I think you just see an acceleration in that regard. I think the people that are stuck in the middle are going to have a hard time, and I think a lot of the mid-price department stores, some of the specialty retailers that focus in sort of in the middle, and are going to have a lot of problems.
So that's really very much in keeping with our framework, Weinswig's Hourglass, where at the top you have, the luxury, the highly differentiated products and retailers' brands, and at the bottom you have value, and in the middle you're squeezed, and you're
Right.
squeezed because there's lots of people going after that customer. Amazon's made huge inroads, and so that is very much in keeping with the way we look at what's happening with the U.S. consumer and retail.
Right. And in any one of these companies, really, execution is key.
Right.
All right. And so you really have to know your business. You have to get into the details, right? And you got to have great people to drive it and understand your customers. So it goes back to all of that, all those kind of basics that you need to master in order to be successful. So the other thing is the consumer continues to change, right? And they have access to all this information, and they're just a lot more selective. So for the bricks and mortar retailers who are going to survive, they've got to invest in stores, improve the store experience, improve the relationship, in terms of what customers want, in terms of convenience, in terms of interaction with staff, in terms of product assortment, sizing, all those things. And so it's just going to be, again, more Darwinian in that regard. But what you see is the strong survive. The strong people that have their act together and are executing on the basis do well. The other thing that I think is important is really scale. I mean, you're looking at the good performing retailers. Scale really counts because it gives you the size to be able to buy right, to be able to attract the right talent, to be able to embed technology in your business, and to be able to improve the store experience or the e-commerce experience. So I think scale does matter. And if you're a smaller middle market retailer, you're very vulnerable unless you have really a niche business where you've got differentiated product or experience that customers respond
to. Okay, so I'm going to wrap it up here because there's been a little bit of difficulty with the audio, but we will have a transcript available, not immediate, and also this a recording of this webinar for everyone who's participated. And we're so glad that everyone joined us for our launch of Retail Legends, of which Michael is one, and a fabulous one. So thank you everyone for being a part of this, and we'll see you next week.